Hello, hello. Can everyone hear us? We're seeing two viewers right now, Lisa.
Yay!
We
Hi,
might
two viewers.
we might need to do like a quick um sound check. You know, we might need to do like a quick sound check just to make sure that everybody hears us. But other than that, um if you guys are here for the live stream, welcome, welcome. Don't forget to like this video, share it with your friends and family because today we're going to be talking about Helocs. We're going to be talking about a lot of other things and of course, always engaging with all of you guys, the Chi fams. If you guys have any questions for me or Lisa, we would love to go over all those questions and concerns that you guys might have. Um, but let's see here. Okay, but of course I do want to also go over the market trend, market data for you guys, just to let you guys know how last week was like compared to the last, just so that we can all kind of get an idea what the market is headed for the time being in Sac County here, Placer and Eldorado County. But how was your week so far, Lisa?
It was fantastic. It's a beautiful week. If you guys got a chance to go outside, I saw the sun, I think, for 30 minutes this week, but I saw it outside of my window and it was beautiful. So I hope you guys all got to a chance to be loving up on this spring weather.
Yeah, it's so nice. With a newborn and everything, we can't wait for him to like get older. Right now, he's learning how to talk. He talks a lot. The baby. I wonder who he got that from.
I wonder, Chia.
Yeah, but if you guys are watching this for the live stream, welcome. If you guys are watching on the replay, do want to let you guys know that I will be putting in chapters in the description box so that way you guys could go through the different chapter topics of this live stream since it's going to be like an hour long. That way you guys could get right to the point of each topic if you guys are watching the replay. So make sure you guys check the description box for the chapters and on today's live stream. But maybe while we're waiting for more people to come join, there's 5 people now. I could go ahead and do a quick screen share on my screen for the market, shall we?
Absolutely. Go ahead.
All right. Okay, so this is what I see, y'all. Y'all already know this. I use this to send listings to all my buyers, sellers, to comparables. This is my baby right here, but we're gonna be focusing on the standard right here. And we're gonna be checking residential, single family, actives. Okay, but before I do that, let me go over here to county. County is gonna be Sacramento, Placer, and Eldorado. Maybe we'll just do 3 bedrooms, 2 bath, okay? And then actives. So let's look at the week before. Do you still have the data for the week last week?
The data. What data?
How many homes? No, you know what? I'll just do it again.
Oh, yeah, do it again. I don't remember.
So we'll do this.
It changes every single day and week.
It does. Okay, so for active homes, 2 weeks ago, there was 131 homes for sale. Okay, 131. So let's look this past week. Let's look this past week. This past week, there's 479 homes for sale. So went up a lot, which is good, right? But it's gonna always change, of course, because homes are going by so fast. Once it becomes pending, that changes. So let's uncheck this and go to closed. How many homes closed? So that way, let me go change 2021 March 26 to here. This is last week sold. So last week there was 415 homes that sold in Placer, Eldorado, and Sac County. This week 389. So a little bit under, but of course the more homes that get sold, the less active there's gonna be. So I wanted to show that to all you guys there, so that way you guys know what the heck the market's going on. But man, not a lot of homes at all, huh, Lisa?
Not a lot. If you think about it, there's 300. How many
It was
was
like,
that, Chia?
yeah, it
300.
was like 400 something homes.
Okay, 400 and something
Yeah.
homes, and 300 and something got sold. And how many families live in? How many people live in just Elk
Oh
Grove?
my
Over
gosh, don't even
150,000,
get me started. Yeah.
right?
How many people are looking?
So yeah, and how many people are actually actively looking out there? The number is very, very, it's a really big. So if you're thinking, there's a couple of things Chia is mentioning to me, and somehow somebody saying don't buy a house, continue to pay off somebody's wealth. Absolutely, if you want to. Those of you who want to be investors, there's a lot of people who still don't believe that home ownership is the start of building your wealth. If you can build it somewhere else, I highly recommend it. But again, this is the easiest start. It's probably one of the most conservative investments that you can make, and it's for you, no one
Yeah.
else.
Nope, you're right. It's if you want to build wealth and you're a lazy individual, I think buying a home is the easiest way to build wealth,
Yeah,
right? Because think about
yeah,
it, it's kind of like a forced saving account. You're paying down your
right.
mortgage, and as the months go by, you're paying down the principal. And when the home market appreciates, like right now, it's appreciating like on average 10 to 20% a year. That's
Yeah.
crazy. Um, like the home value is gonna keep going up, and that's your savings account right there. And
Well,
and like when you have equity, you can utilize that equity in the form of a HELOC, like what we're gonna talk about, like what we're gonna talk about in today's topic. Some of you guys are asking about that, and then the another topic you guys are also asking about too is commissions. How much you guys should pay an agent, if it should be percentage or a flat rate, and I will definitely share my thoughts on that, and then kind of go from there. But what was you gonna say, Lisa?
um, I totally forgot.
I'm sorry. I do that a
I
lot.
got I got interested in what you said. I was like, oh, that's cool. Yeah, we're gonna talk about good stuff today.
Yeah, we are. Hey, we got a comment from Matt the
Yeah.
Mortgage Guy. Do you know Matt the Mortgage
Hey,
Guy?
Matt. I do know Matt.
He said, just here to say hello.
Hi, Matt.
Yep, he came by to say hello.
Aw, that's awesome.
We
Thanks, Matt.
we
Thanks for your support.
we probably need to do a three-way with Matt one of these days, right? Cause he has a YouTube channel too.
I
You
know.
know?
I check him out too.
Yeah. So me and him were supposed to uh get on a podcast together, but I've been lagging, so I apologize, Matt. Been too busy doing my own thing. But it's funny because since we're talking about Matt, you know how I met Matt? His kid does jujitsu, and my kids do jujitsu too. And then
Oh,
we went to
small
yeah,
world.
we went to a competition over in the Thomas, and we were registering, and I saw Matt. Matt saw me in line. Matt was like, "ChiaTalks."
Yeah.
so so yeah, we were supposed to hook up, but maybe one of these days, Matt. But okay,
I
what?
No, I was gonna say when I met Matt, I told Matt it's like Matt and I are like Coke and Pepsi. He's Matt the mortgage guy, I'm Lisa the lending lady. Nobody else matters. I'm just kidding.
No, it's good to it's good to like network with the people that's within your same industry, because
Yeah,
you never know what you can learn from one of them. You never know if you're gonna be like partners with one of them. It's such a small world.
it absolutely is.
hmm But okay, maybe we could get started with the topic. Maybe I could talk about the commission part of the topic, and you Chichi fams that filled out that poll last week about the questions. Thank you guys so much for filling that out. So this question, of course, came from one of the Chichi fam members, and they wanted to know: should a seller pay a listing agent a percentage of the purchase price for the commission rate, or just a flat fee? And for me, I feel like it really depends, right? Um, I get interviewed a lot by sellers on my commission part, and this is always a part where I always tell the sellers, you do get what you pay for. Because with me, my listing service, what I offer is I offer staging with the listings. I offer professional photography, marketing, and most importantly, like I offer my negotiation skills. If I represented you as a client, like I'm gonna do everything in my power to negotiate the best deal for you if you are my seller. So that means I'm gonna be vetting through all the buyers that are coming in, and I'm gonna be interviewing basically every buyer's agent. So it really depends, and you're gonna, I'm gonna be in full communication with everything, and normally around there, the average commission rate is about 2 to 2.5% for the listing side, and of course, you do have to pay the buyer's agent side too. That brings you a buyer to buy your home, another 2 or 2.5%. So in total, you as a seller, you are forking out about 4 to 5% right off the gate for listing services. Okay, so that's one thing you need to remember, seller, is that's the commission side. Now, when I said earlier that it depends on the commission, whether it should be a flat fee of a couple $1,000s for the transaction or the percentage, it's because if it's a mobile home, obviously a mobile home or a manufactured home is like what, 30, $60,000. It doesn't really make sense to go a percentage on that. So a lot of times those flat fees makes more sense for those type of transactions. But I think most importantly, what every seller should ask themselves is, what am I looking for when I'm hiring an agent, right? What do I want done? Do I want ease? Do I want like an easy going transaction, or do I want a transaction where I'm doing all the heavy lifting as a seller? Because I'll tell you guys right now, when you guys are hiring an agent to list your home, that's really the one of the number one reasons why you're hiring an agent to put your home on the market, is because one, you don't know any of the documentations, you're not a savvy seller, and you have a life. You have a life, and you don't want to be answering the phone calls of hundreds and hundreds of buyers inquiries to come and take a look at your home. So that's why you hire an agent, so that way they can alleviate the stress for you, so that you can focus on your daily routines. And that's really why a seller would hire a listing agent. It's really for that purpose, and of course to negotiate top dollar, and to know the market, and to do all the negotiations for you. I mean, am I missing anything else, Lisa? What do you feel?
Okay, so as a non-biased lender, uh, it's when you hire anybody, it's just thinking about if you go to court, you can absolutely represent yourself. You can hire that lawyer down the street, or you can hire one of the top lawyers when you go into court. If you have a situation, who do you want to be your strategist, your negotiator, your research person who
Yeah.
knows the guidelines and knows the laws, okay? Who looks beneath the surface of how to sell your property, but how do they maximize that? And typically, the agents who do charge more, they come with a much better value, just like you, Chia, because again, they're going to go ahead and not just look at what's on Zillow or whatnot, but how do they make your home stand out? So whatever percentage that you're paying your agent, if you're paying 2.5%, but they're able to give you a 10% increase of your property, isn't that worth it?
Yeah.
It's almost like you're paying them for free anyway. Okay? And when you leave money on the table like that without knowing, you may not know it, but what you don't know could absolutely hurt you in the long run.
No, yeah, you're 100% right. Like, there's been so many times where I'll have like a seller call me that was that felt like they could handle the for sell by owner transaction by themselves, without paying a listing agent, and then they end up selling the home for so much cheaper than what they could have really gotten for it, right? And they leave money on the
Right.
table. And if you're doing a transaction like that to where you're representing yourself and you're listing it as a for sale by owner, but you don't really know much about the transaction, you've probably heard a few tips from YouTube and all of that, or you have a friend or family member that's an agent, but then they're kind of giving you tips on the side, and you're doing it all by yourself, you're gonna be very frustrated with the process, because most likely the buyer that's gonna come in and look at your home is gonna have an agent. And if they have an agent, that agent does this full time. This is their livelihood. They're gonna know what to ask. They're gonna know what to look for. They're gonna know how to negotiate your home. And if you don't have anybody like that in your corner, man, it's gonna suck so bad because you're gonna be leaving potential money on the table. They're gonna be negotiating everything for you, and you're gonna feel like, oh my god, like what should I do? What should I say? So it's so important. It's not just a matter of putting your home on the market and putting the listing sign on and then praying that, oh man, my home's gonna sell. Yes, it is a hot market right now and homes are going like that. Yes, but the transaction is still there. The due diligence are still there. The documents and disclosures are still needed. You're still going to need title and escrow. You're still going to need all these inspectors coming in there because it's not just involving you, the seller. It's involving you, the middle escrow individuals, the buyer and their agent, the appraisers if they're utilizing a mortgage, the loan officer on their side. It's going to be involving so many parties. And if you don't have anybody on your corner navigating through all of this, it's so easy to go through like all the mess, and so like if you guys were here last week where me and Lisa were talking about teamwork, that's why we prefer to send clients to the lenders that we prefer to work with or have a relationship with, because we know how they work and it makes the process so much easier for you, the client, not for us, for you. It makes it so much easier because we already know that the lender's gonna do this and that, the agent's gonna do this or that. So it makes it so much more easier for everything to just go through that way. So that's why we prefer to work with the individual mortgage partners that we send you guys through. It's because of that. Okay, it's so important. Teamwork is so important for your sanity.
Right. So, I mean, as an investor too, most investors will look for off-market type of deals and deals for people who want to sell their house on their own. Why? Because investors know exactly what to say to entice sellers to sell at a very, very cheap price. That's how they make their money.
Yep, that's true.
Mm-hmm.
So before you consider doing a physical by yourself or consider like maybe even lowballing your agent that's going to be listing the home for you, see what value propositions they have for you. Like what are they going to be doing for you? Like speak to some of their past clients that utilize their service as a listing agent or buying agent and see what the clients have to say. Because, data don't lie and people don't lie about things like that. Their experience. People remember their experiences. So that's what I would highly recommend you do. Any seller in this market, even if it's a hot market, you don't want to get taken advantage of by anybody. You don't want to be that person that decided to leave money on the table. Okay? Because there's a lot of money to be made, especially in this market.
Mm-hmm.
But yeah. Okay, let's read some comments. So we got Nicholas Ramondi. Hey, happy Friday. Got the fiance listening with me this week. I'm glad you got your fiance listening in, Nicholas.
Congratulations, guys.
Yeah, fiance. I wonder when the wedding is. That means getting soon. It's coming soon. But okay, we could probably go on to the next topic. But hey, Cheat Sheet fans, if you guys are watching right now and you guys got any comments or concerns, comment down your questions in the live chat and we will answer them accordingly. In case there's anything that we might miss and you guys want us to answer for you, put it in the live chat, okay? But maybe we could talk about the Heloc, Lisa.
Sure. So somebody asked about the Heloc, which is a really, really great question. For those of you who don't know what a Heloc is, it's a home equity line of credit. In short, it's like a credit card that it's against your house, okay? So say, for instance, if you have a home and it's worth roughly about $400,000 and your current mortgage, you have about $200,000 left. Typically, banks that do home equity lines of credit, I don't, but I still have a home equity line of credit on my own home. It's very, very valuable, so I'm going to get into that in a little bit. But the numbers wise, if your home is worth about $400,000, You owe roughly about 200,000 on it, which means, and you do have to leave about 20% of equity in your house, which means the max you can probably take out on a home equity line of credit is about 120,000. Of course, they're going to look at your income and see whether or not your income will be sufficient for that. But let's just say that you're able to take out 120,000. The greatest thing about a home equity line of credit is it's a great safety net. And what I mean by that is life happens. You never know. Loss of job, something, and sometimes you need a little bit of a cushion. That's okay. But just like a credit card, you know how like if you don't use it, you don't have to pay a monthly payment on it. Okay? So it's just there for you to have as a cushion. How many of you guys feel like, okay, if something goes wrong, if there's a health issue, medical stuff, things like that happen, wouldn't it be nice to know that you had, $100,000 on the sideline ready to be used if you need it?
Mm-hmm.
To me, that is the biggest factor why you should have a HELOC to begin with, okay? And the cool thing about HELOCs is that the payments are fairly low. They're low because they only require you to pay the interest only. So if you take out $100,000, okay, let me run some numbers for you guys here. Okay. Okay, then let's just say the interest rate for a home equity line of credit is 4%, which means per month you're paying roughly about $333 a month for borrowing $100,000. Okay, so the good news is the payment is fairly affordable. It is a 10-year loan. However, if you do only pay the $333 a month, by the end of 10 years, you're still going to owe $100,000. So be very, very careful with that. HELOCs are great to use in emergency situation. It's great to use if you know for a fact that it's short term and you have something coming in to help pay that off quicker. Okay. So one, it's really, really good as an emergency backup just in case. Two, a lot of people actually use it. Say if you're able to take out $100,000, that's the down payment for their next house already without having to sell their home. Mm-hmm. Yeah. Okay, so we run the numbers and if it makes sense for you, that's kind of cool. That just think about how the last time I crunched the numbers. If you're buying a $400,000 house and you only need to come in with $25,000, then you wait about 5 years, you build up enough equity, you take out a home equity line of credit, and you buy another home. And you started off with only $25,000. So how do you not build wealth? If you continue to do this route and continue to have more home equities or even a regular home loan to purchase your next home, you're really setting yourself up for a really, really nice, cushiony future. Because let's just say by the time, if you're buying homes and you're in your 30s, by the time you're of retirement age, your mortgages are paid off. So the homes that you're renting out, you're pretty much, getting about $1,500 every single month off of one home only. On top of that, you don't ever have to pay mortgage again on your own home. How many of you guys would think that that would make your life pretty easy by the time you retire, right? Okay? And that's just with one house, two house. Imagine if you had multiple properties, what it can do for you.
Lisa, I do want to ask you something.
Sure.
So, for the HELOC, isn't there two different types of HELOCs? 2 or 3? Where one is like a line of credit and then the other one is more like a loan?
Yes, it is. So, typically, if it's a loan, most of the time it's a conjunction with your first loan when you first purchase the house. So say for instance you don't have enough to purchase the house, some lenders will allow you to have a second loan. Sometimes it still is a line of credit, sometimes it's just a straight up second loan. You can do that, okay? It really depends on what bank you go to. But today, since we're on the top of home, just the line of credit itself, that's exactly what it is. It's a line of credit. So if you have a line of credit for $100,000, okay, and you use $100,000 and then you pay it off in about 2-3 years, it starts your $100,000 all over again. So you can always use it. Whereas with a loan, once you pay it off, that's it. You have to get another loan in order to use it. So again, it's very, very similar to a credit card. You know how when you pay down and you pay off a credit card, okay, great. 2-3 months down the line, you don't really need it. But a year down the line, okay, you need to get some. Then you use your credit card again. Exactly like that with a home equity line of credit, okay? Because it's like a big, giant credit card the collateral is your home. So people use it for home repairs. People use it to even buy cars, to pay off debt. If your credit cards are in the interests of 20% and your home equity is only 4%, you might want to consider using your home equity line of credit to pay off that debt. So for a credit card, okay, if your payment is already $100, or I'm sorry, $1,000, and you only owe 25,000 on it, you move it over to a home equity line of credit, you only have to pay $50 on it. It's a huge difference, right?
Yep.
And because you're so used to paying that $1,000 already anyway, just continue to pay that $1,000. You're going to pay it off a heck of a lot faster because the interest is much, much lower. The interest for a home equity line of credit is probably only about 4% right now.
Wow, really?
And again, I don't do home equity lines of credit, guys. I just want to put it out there, but I highly recommend it. If you do have equity in your home, the criteria for getting a home equity line of credit is much, much more strict, just simply because, again, once you use it, it's considered a second loan, and it's a lot riskier for the lenders when people have a second loan on their house, okay? So if you are wanting to take it out, but you don't really need to use it, perfect. That's great for emergency money. If you want to use it because you want to see, okay, if I take it out and this is how much I'm going to have to pay for home equity, a line of credit, and if I purchase a house again, how much is it going to cost me? And it might really work in your benefit when we look at the numbers for you. And then if your house is falling apart and you feel like, okay, you don't have the money to fix it up, and things like that, home equity lines of credit are great for that. Cars, I don't recommend this one, but people do it, okay?
Yeah.
People do it, okay? You can do that as well. Student loans, if you have a kid going to college, I have a lot of people using that to do it too. Paying off debts, starting a business, that's one of the biggest things. So if you are starting a business, home equity lines of credit might work really, really well on that. And one of the other things that people do is that they do use it to funnel their other investments. So if you're
Let's talk about that.
Okay, that's going to be a whole segment for another time, but I'm just going to get into it very, very, small
We got time.
portion of that, right? So let's just say, for instance, the home equity line of credit, and this is where the term hard money and private money, a lot of people do this when they're doing hard money, okay? So let's just say you have $100,000 in your home, you don't have anything to do with it, and somebody comes up and tells you, it's like, hey, dude, I really need to borrow some money. If, can you lend me $100,000? I'll give you 10% of interest on it. So let's just say if that were the case, and you take out this home equity line of credit that you have leverage to, that you have access to lend it to somebody else, you're paying $333 a month. They're paying you $1,000 a month. You just pocketed the difference of that. So that's one way that some people do to utilize other people's money, because whatever the home equity line of credit is, that's you utilizing the bank's money in order to funnel that, okay?
So I'm curious.
Mm-hmm.
For people that are utilizing a Heloc to buy a second home,
Mm-hmm.
when they do that, their first home has to be considered an investment, correct?
No,
No?
it does not. Mm-mm. Mm-mm.
Because
So give me a scenario, Chia, and let me break it down.
so let's say a couple has a home already that they're living in, but they want to upgrade that home because that home is just too small. They probably want like a bigger home. So they have
Okay?
equity in that first primary home. They're taking money out from that as a Heloc to buy the second home. That's possible, right?
Yes.
So
Yes, that's absolutely possible.
so then if they're doing that, does the second home have to be considered an investment purchase or can
No.
it be a primary?
It can absolutely be a primary if it fits the primary category. So let's just say, for instance, if you do have a smaller home, basically the banks want to know whether or not you're actually going to live in the house. So if it's a bigger home, it's another, it's a bigger square footage, your family has grown, or let's just say, even though you're living in a big house right now, you're downsizing because you're retiring. The bank's going to look at all of that. So as long as they can determine that you truly are buying it as a primary residence and you're not taking advantage of the primary interest rate, okay, then you're fine. You can do that, okay? And again, it's not just whether or not you can't or you can. You still have to qualify income-wise, credit-wise, and all of that stuff.
Right, right, of course.
Okay?
So, man, because I hear a lot about people utilizing Helocs to pay down their mortgages and
Oh, you can definitely do that.
like
You can
5 to 7
definitely do that.
years.
Yes, that's called velocity banking. That's a segment for a whole other time, Chia, because it's I can go into it for hours. It's a wonderful thing, but it really just depends on the individual because um, I did it. I did it on my house a little bit, but then I decided to hold back just because, like, one, my main house is my tax write-off as well. So I didn't do that. I do that more for my investment properties because they're a little bit more costly for me. Okay. And the way that works is because when you do that, you can control more of what you put into principal. So when you get a home loan, okay, for the first 5 years anyway, most of that goes into interest instead of your principal. But if you're doing it as a home equity, so let me break down the numbers for you. If you're doing it as a regular loan, same terms, 10 years, okay, you're going to have to put in about $1,000 every single month to pay it off in 10 years. However, when you do it velocity banking style and you're doing it this way, where you already know what your monthly interest only payment is. And if you make the exact same payment, which is $1,000, okay, you're making the exact same payment, you can actually pay that off, okay, in about 5 years, 10 months.
Hmm.
Mm-hmm. So that's how they're able to shorten that. Does that make sense?
So then my question, I'm very confused at the same time because like
Yeah.
if somebody utilized that, right? Don't they
Uh-huh.
still technically owe a mortgage if the HELOC now is making the payment
Yes.
for?
Yes.
So
Yes.
so you're
You're
technically
just
now
moving money.
you're just moving money.
Yeah, you're just moving it to a vehicle that will allow you to put more into the principal instead of more into the interest. So every single month, your loan goes down faster, which means the interest payment and the principal payment, everything it's smaller, faster.
Got it. Because you're paying directly towards the principal.
Correct. Correct.
Oh man, so many things are going through my head.
I know, all those numbers flying all around, right?
Yep, for
Yeah,
reals. Oh my
you can
gosh.
totally do that.
Okay, so and you said that you currently have a HELOC right now, one of your properties,
Yes.
and you got it. Okay, interesting.
Mm-hmm.
All right. Well, let's go to the comment section, shall we? Unless there's something else that you should add regarding the HELOC.
No, I hope that the audience understands that a little bit. I mean, we can break down every single one of them. It is going to be a bigger one, and the pros and the cons of each. Now, I would recommend it if it's for short term again, okay? Because if you're only making the minimum payment by the end of 10 years, you're still owing $100,000, guys, okay? So unless you know for a fact that you're going to put more into it, just like how you would pay off a credit card, okay? Then I would recommend it. Now, if you know that when you first started off, you started off with a HELOC with all the intentions of paying it off sooner, but something happens, you had to take a pay cut, well, something like that, then I would say, okay, let's see if we can convert it into a regular loan so that the principal payment can automatically be made to that. Typically, a regular loan, the interest rates are lower than the HELOC's interest rate.
Of course.
Okay?
Since we're on the topic, because you
Mm-hmm.
mentioned earlier, let's talk about hard money.
Okay.
Do you guys offer hard money?
We do.
You guys do.
We do.
Can you talk a little bit about the terms and
So it
why?
really depends. It really depends on which hard money because hard money lenders and private lenders don't abide by regular rules because
Right.
they're their own identity. They're their own pretty much bank. They have their own money. They're not borrowing money from the government to do this. This is their own money. And hard money a lot of times is a pool of people who have these HELOCs, okay, who say, okay, I don't know what to do with this money. I don't really need it, but I want to make some money off of it. So they have a pool of people putting money in like this. And let's just say you don't qualify for a traditional mortgage. You pay off everything. You never took a credit card, so you don't have credit. You don't have anything of that situation. Or you are a self-employed person. You write off everything on your taxes, so there's nothing, no income that a traditional bank can go off by of what your income is. So now you got to go to a hard money type of situation. So if that's the case, then these people might actually work very, very well for you. Now, hard money is not cheap. Hard money typically is around 8 to 12%, depending on what your situation is and depending on how experienced you are as an investor. Most hard money lenders would prefer to give it to investors just because they want people with the experience. It's a riskier loan. That's the reason why the interest rate is much, much higher. And if you want to be in that pool, definitely there's companies that will say, okay, in order to be a part of our pool, you got to invest in 100,000 or you got to invest in 200,000, whatever their cap is. Then that money has to sit there for a certain amount of time for you to get that money back.
Got it. Now, let's say a family just moves here to the
Okay.
States. No
Okay.
credit, no income, but they got a lot of mattress money.
Okay.
And they want to buy a home.
Okay.
How can they buy a home?
So is the mattress money enough for them to buy a home?
Yeah, it's enough for like a 40% down on a $300,000 home.
Okay, then that's awesome. So there are stated income loans. You do not have to go directly to the hard money just yet. If you have credit, if you don't have credit and you don't have any of that stuff yet, okay, then you can go to the hard money. Hard money, they do check your credit now. They used to not, but because of the what's going on in our economy, people are just in general a little bit more cautious. But in the traditional hard money, a lot of times they don't even look at your credit at all. They do require for you to put at least 30% down typically. So in that situation, they can absolutely do that. Again, the interest rate is roughly about 8 to 12%. Nothing else matters. The biggest thing with hard money though, those are short-term loans. These are
Yeah, talk about
people,
that.
actual people who are putting their pool in, so they want their investment money back as soon as possible because the longer it's in there, the riskier it is for them. So a lot of times these hard money, if they'll give you a deadline. It's either 6 months to 2 years, okay? Typically. So if you don't have the money to pay it off in full during that time, or if your situation doesn't change, I have a lot of people who, when they first started out, again, they were self-employed, they just moved to the United States, they didn't have all of that set up. So what they would do is get a hard money first, get all of their situation set up, and then I'll refinance them later on into a regular loan. Hard money, if you don't pay it off, it's called a balloon payment. By the end of those 6 months or 2 years, if you still owe $150,000, you're going to have to pay them back $150,000 right then. Otherwise, they will foreclose on your property.
Normally, you could extend, right? Let's say it's getting close to your end of the term to pay the hard money back. You can request for an extension, right?
You can. You can. It doesn't mean that they have to give you the extension.
That's true.
So you have to be very, very careful with that. Okay? The hard money people, again, they're the loan sharks almost of the lending world. And I don't mean that in a bad way. I mean that in a way where it's like, hey, if you can't go to anywhere, they're the money mafia people. Okay. So if you don't pay them, they're not answering to one person. They're answering to a pool of people who gave that money in that pool, and those people want their money back.
Yeah, and like some of those people they're probably utilizing their Heloc, right? Like their home equity lines. Oh, I lost her. I think I lost Lisa. Oh, yeah, I think I lost Lisa, y'all. Maybe we're gonna be cutting the live stream short today. Man, we're 20 minutes early. Okay. Okay, I think we're back. Yeah, something was going on with our connection. So sorry, y'all. I was just gonna say, man, I think we're gonna be cutting it short today, Lisa.
That's
20 minutes
okay.
short. No, that's not okay. We were just talking about something pretty intense.
Yeah.
So what was it that you were saying again about oh yeah, so I was saying some of these loan sharks, these investors that are pulling all their money in together to lend it out as a hard money, they're probably utilizing their Heloc.
Exactly. So even if you don't pay them, they're going to have to pay back their loan. So that's where I would say if you're going to go into something like that, which you absolutely can, you got to make sure that you're protected too. All the money that you're making, make sure you put it on the side. So in the event that somebody who's borrowing money from you isn't able to pay you back in the timely manner, at least you have a cushion.
Yeah,
And
yeah.
vice versa, the hard money lender who lends it to you, if you're using hard money, they're going to want the same thing.
No, that makes perfect sense. So then people that should be utilizing hard money, if you're flipping because they're short term, right? Normally two to
Yes.
3 years. If they're flipping a house and they want to leverage somebody else's money, maybe they don't have enough capital. A person that doesn't have uh, income or credit wise. But remember, if you're this type of person, have an exit strategy. Don't plan on buying a home and then waiting to deal with the refinance later when the end of the term comes near, because you might not get that second chance by these loan sharks. They might not even want to give it to you. They might just
Exactly.
repo your home.
Well, not only that,
Foreclose on
usually,
it.
usually if they give you an extension, it's gonna come at a cost.
Oh yeah. What I've seen is they would increase a percentage. So instead of it being 10% for those first 2 years, it's now 11 or 12%.
Correct. Not only that, they will charge another origination charge. So they'll
Yep.
charge you, 2 points or 2% of whatever you still owe them. So if you owe them $100,000, they're gonna, charge you another $2,000. It might not seem like a whole lot, but usually when people are using hard money, sometimes it's $500,000. So it's $10,000.
Yeah. Okay. Well, we got a question from Josh Zong.
Hi,
Um,
Josh.
it says, "Can you get credit line to build a new home on a piece of land you purchase?"
Absolutely. You can do whatever you want with your home equity line of credit.
You hear that, Josh? You can do whatever you want, okay? Just don't go buy a boat because that's not important debt. Just don't use that line of credit to buy a boat or a motorcycle or a car.
You
Use it for
can, you
you
can,
can.
but you probably don't want to.
It's not gonna be a worth. It's not gonna be worth the debt because again, you still owe this money.
Yeah,
Use it for something that's gonna make money for you or it's gonna mean something.
yeah,
Like for example, maybe you want to use it to fix up your house, and then maybe afterwards, when you do a refinance, your home is worth more now.
yeah,
Something like that. But okay, that's really interesting. So another thing too is I uh I get people asking me all the time, Lisa, about like how to get qualified to buy a home. I know that we talk about this a lot,
yeah,
but I think it's one of those things to where you can't over communicate this enough times, right? Because people forget.
yeah.
So can you kind of walk us through a little bit about like the process of first time home buyer coming to talk to you and just what you ask for, what you look forward to get them qualified to buy a home?
Yeah, absolutely. I think people are just going to continue to ask this, and a whole new group of people are going to continue to ask,
Yeah.
just simply because just because this is part of the American dream, it doesn't mean that it's not attainable. Because sometimes when people think of the word dream, it's like, oh yeah, that's something that's not attainable. That's not true. Okay, it is absolutely true. We're in a market where you can put very minimal down and be able to own a home. And the three big things that the banks look for in order to qualify is your credit, your income, your assets. So I call it the CIA, okay? Based on the combination of what your credit is, the combination of how much you make versus how much debt you have versus how much you're willing to put down. So the more you put down, the more options that you're going to have, the better your credit is, the better your options are going to be. The less debt you currently have, the more buying power you're most likely going to have.
Got it. You guys heard that? And when in doubt, just reach out to a loan specialist.
Yes.
I cannot preach about this enough, guys. If you really want to know what your current situation is like, not what your sister's situation is like or your best friend's situation is like, what your situation is like, talk to a loan specialist so that way they could dissect your financial situation. Ask for all your docs, your pay stubs, your bank statements, and see where you fall in line as far as how much you qualify for, how much interest rate you may be able to lock in, etc. So when in doubt, reach out to a loan specialist. And a lot of times, they do this for free. It's a consultation. Some do charge, but ask that question beforehand, okay, before they run your credit or anything like that. But we have another comment from Georgina Cheng. I have a non-HELOC question. We just went into contract and we are trying to decide between 7 ARM at 2.625% or 30-year at 3.25 on a $1.5 million mortgage. Any suggestions on how to make that decision?
Okay. How long are you planning to have this house journey, Gina?
How long are you planning on having this house? It's a duplex, by the way.
Okay, it's a duplex, so you're renting one side out. So really, you got to take a look at the numbers. Ask your loan specialist to do a side-by-side comparison for you for a 7/1 ARM versus a 30-year fix. What's the difference in the payment going to be? Then you multiply that difference between how long you want to keep the house for, and if it's going to be a short-term thing where it takes you 10 years to recoup the difference of the cost of that, okay, then you might want to choose the one that gives you the most cash flow, okay? But if you know that you're going to keep it for the long term, okay, take a look at what the difference of what you save long term versus that 7/1 ARM, okay? So when you're doing that, you have to ask yourself, is bird in a hand better than two in a bush?
Uh-oh. I think we lost her again. Something is going on with our internet connection, y'all. Georgina, we'll be right back to answer that question for you, okay? Something's wrong with her internet connection.
Gaming and a whole bunch of stuff. So pardon me because my internet is not as strong right now.
No worries. Okay, well, we have Lisa back now. So, what was you saying earlier in regards to Georgina's question?
Okay, so Georgina, I don't know if you heard this, but make sure that your mortgage loan specialist is also a strategist for you. And what I mean by that is have them do a side-by-side comparison for you, the 7/1 ARM versus the 30-year fix, multiply it by the amount of years that you're projected to hold on to this property. Take a look at how much of that difference in those two programs would cost you and how long it would take for you to recoup the difference if you choose one over the other, okay? And if you are holding it for long term, at what point are you going to start saving that money over the other program? Does that make sense? You got to take a look at it side by side first. That program doesn't make sense for somebody that has a mortgage of less than $500,000, but if your loan is in the 1.5 million, yes, the difference of that rate probably is a much bigger difference per month. So I would absolutely take a look at that.
There you go, Georgina. And we apologize for the network kicking us out. But Lisa's gonna promise to switch to AT&T next week.
Trying to
Because
get somebody out here.
I'm telling you, Comcast, when I had them, my upload speed was horrible. But the moment I went to AT&T, oh my gosh, night and day difference.
That's good to know. I just hope my neighborhood actually has something different.
I think they do. They should. Fiber should be good over there. Okay, so Georgina says, gotcha. Makes sense. Yes, difference is like $500 a month.
Usually for that loan size, it's a pretty good difference. I haven't done one in a while just because most of my clients are here in Sacramento, but my Bay Areans who have the $1 million jumbo loans and whatnot,
Bay
yes, that
Areans.
does. My Bay Areans. I'm a Bay Arian too. Um,
Yep. Jumbo loans. Jumbo loans.
yeah.
What's the limit right now to be considered a jumbo loan?
It depends on what bank, but typically anything under 2 million, and it depends on what area too, Chia.
That's right. That's right. Okay. Okay. I'm just going through the comment section. Nobody right now. Oh, Georgina Cheng is also a Bay Arean too.
Oh, I figured with a 1.5
That's yeah, that duplex. I was
loan.
gonna say
Yeah,
I don't think there's any 1.5 million duplexes around here in Sacramento.
not yet.
Yeah. Oh my gosh. Don't start.
Not yet. Don't tell the Bay Areans.
Oh my god. Man, you know what? Since we have a little bit of time, let's talk about my video I released today.
Yeah.
Um, man, so the Biden administration, they're planning on proposing extension for people that file for forbearance.
Yep, dun dun dun, right? Which is actually not a bad thing, Gia. It's actually kind of cool, okay? They don't want what happened in 2008 to happen now, so they're kind of foreshadowing. It's like, okay, we got, over 10% of people utilizing that forbearance last. If the banks all go foreclosed and everything like that, a lot of people are thinking, oh, okay, so those are the homes that might go back on the market. If you're thinking that more inventory is coming because of this, that might not be the case because of this anymore.
Yeah,
So we got to be really aggressive with the homes that are willing to sell right now.
that's what I'm telling people. I'm telling people, hey, if you're waiting for the crisis to come, the foreclosures, the forbearance, house down, meltdown, all that to create inventory, that's not happening. Especially if this proposal gets passed, that means people that can't really pay because of the hardship right now, they're gonna even be like skipping out on their mortgage even longer. That's crazy. Up to 40 years.
So what
That is
that
crazy.
means, yeah, what that means is okay. So people who were in forbearance for that 6 months, they were given that 6 months to not have to pay their bill to get their back on their feet and restart their jobs and things like that. So what they're saying is instead of you having to pay that balloon payment, which to me didn't even make sense to begin with. If you're in need of not paying your mortgage for 6 months and the bank is saying, all that months that you didn't pay, now 6 months is over, we want you to pay the whole amount. That's just silly. That defeats the point of having the forbearance in the first place, right?
Right.
So now they're proposing this thing where, okay, we'll just go ahead and add a little bit of your loan to it. And now he's even saying, okay, since you're having a hardship, instead of the loan being 30 years, let us stretch it out for 40 years so the payments is going to be even lower for you, so it
Mm-hmm.
makes it a lot more affordable so you can keep your house longer. So last week when I did the price out for you guys, okay, whether you wait or you buy later, okay, you think about it. Even if you buy quote unquote right now at the high, which I don't even think that we've peaked yet, okay, but even if you buy it and your monthly payment is right where normal rent is supposed to be or even higher, let's just say it's even higher, but think about that, guys. Worst case scenario, you keep this loan for 30 years. In 30 years, just think about how old you'd be and how awesome it would be if you never had to pay anybody rent and you already paid off your mortgage. That is the worst case scenario. I mean, that's not a very bad worst case scenario, in my opinion.
Like I was saying earlier, to in the beginning of this stream, that's the slowest and laziest way of building wealth is owning a home. Yeah, it's
Just,
high right now, but we don't know how high it's gonna be, especially if
yeah,
this proposal gets passed. It's gonna be long. It's gonna keep going up.
yeah.
And even though there's no inventory, it's gonna keep going up. And Josh had another comment saying, "Do I think there's gonna be another market crash?" I don't think it's gonna be a market crash this year, Josh. To be honest, if you were here last week during the live stream, me and Lisa spoke about this. There's not enough data to support a market crash yet, and especially if the Biden administrators pass this proposal for extending the forbearance period for homeowners that's in hardship, there's gonna be even less inventory, and the crash is not gonna be coming anytime soon. It's gonna be even worse. home price is gonna be even higher.
Well, let me
And
add a little bit to that, okay, Chia? Let me add a little bit to that for
yeah,
people
go
who
for it.
don't know, people who don't really know the facts. Now, of course, all this information you can totally, absolutely Google it. Take a look at all the footnotes. Make sure that your source is reputable and everything, because of course, these are all our personal opinions too. So a lot, people are thinking, okay, for all the forbearance that happened, that's the slew of houses that could be coming up. People who are paycheck for paycheck, utilize down payment assistance, but now had lost their jobs and had to be in this predicament. Well, again, this bill, if it does pass, it's to help alleviate that, which means that slew of homes that's supposed to come up is not going to come. And on top of that, think about it. If you're paying your mortgage at market rent right now, you're going to do everything that you can to try to hold on to it, because even if, let's just say, these homes go into forbearance, these homeowners, they have to live and they have to go somewhere. They have to live somewhere. And they're looking at it, I was like, oh my gosh, if I lose this house, my monthly payment right now is $2,000. If I go rent, my rent is also $2,000. It does not change my monthly situation. So I'm going to try harder to try to see what I can do to try to hold on to my house. And if I'm able to now stretch out my payments in 40 years instead of 30, maybe my $2,000 mortgage is now only going to be $1,500, much, much more doable. Where the heck are they going to move into the same house, 4 bedroom, 2 bathroom, for $1,500 a month?
Yeah, for reals. And I'm also just feeling for all the renters,
Yeah,
right? Because there's
yeah.
these because all these investors right now are like what, kicking out or vacating their homes so that way they can sell it because they don't
Mm-hmm.
want to deal with the potential eviction moratorium being an issue for one of their tenants. So they're selling
Yep,
off their properties, right? And
yep.
yeah, I'm worried about that too. Another thing too is like I think we got another comment here from That Sibling Life. I like your name. They said any down payment or closing cost grants in California right now. That's you, Lisa.
Yes, yes, there is. So certain banks have ones that are very specific. What we have now is a down payment assistance that is, it's not a grant, it is a second loan that you're paying on. You pay it off in 10 years if you hold on to it for 10 years. There is CalHFA still that's out there. It's coming back to more lenders are utilizing that now that the pandemic, goodness, I'm hoping that we're at the butt end now with the vaccines coming out and such. But yes, we do have down payment assistance. Come on in and let me know how I can price that out so that you can see how much it looks like, okay? Typically, though, for down payment assistance programs, the interest rate is higher, okay? So definitely, if that's something that you're interested in, reach out to us and I'll be more than happy to price that out and see how that looks like for you.
Yep. Another thing you want to also consider for down payment assistance is um, right now with the competition going on, I want you to give you guys a tip, okay? All you guys are buyers right now listening in. Um, Sellers are being super picky when it comes to picking offers. I want you guys to know that, okay?
Mm-hmm.
If they, because just put yourself in the seller's shoe for a second. They have 20 offers. Majority of them are probably over asking. They have a FHA, they have a conventional, they have all cash. They have a down payment assistance. Which one do you think they're gonna choose? Most likely the cash, unless the FHA or conventional is gonna come up in price to where the seller nets more. It might be either or. But down payment assistance, I'm telling you guys, it's always and normally the last resort a seller would choose because they're afraid that the loan might not go through. Especially with last year, if you guys watch some of my videos I uploaded to the channel, where when this pandemic first hit us, Lisa, remember how they were super tightening on guidelines for FHA and down payment assistance, and it took
Yep,
away some of those fundings. All
yep.
of a sudden, people that were qualified to buy a home with down payment assistance are now no longer qualified.
Oh, that's so crazy. I think, I mean, I was so happy when one of our clients actually was the last to get the down payment assistance. And we were so happy because as soon as she closed, the very next day, they did not have it anymore. So
Yep.
if we didn't close that day, oh my gosh, and we didn't even know until the day after. So it was
Yeah,
it was
and
pretty crazy.
it was like, oh god.
Yeah, absolutely. For
Yeah,
sure. For
it was
sure.
all meant to be because this buyer wanted to utilize down payment assistance because they wanted to use their extra funding in their accounts for like appliances,
Mm-hmm.
furniture, and all of that, and so they utilized down payment assistance to buy their first home. And like we had delays, right, Lisa? Remember, we had delays after delays because of repairs and appraisal issues. And so
Mm-hmm.
because of that, the moment we closed and the program went out, if it would have been a day late, she wouldn't have been able to utilize down payment assistance. I don't even know if the sellers would have given us an extension for the escrow. We
Yeah.
would have canceled.
Yep.
So like that's one thing to consider, that sibling life. If you are planning on utilizing down payment assistance, talk to your loan specialist to get their take on how they feel about the economy and if that program is going to around for a while. And also speak to your realtor that's representing you and writing out these offers to see if it's going to be a compelling enough offer for that particular home. Because I'm telling you, right now, with all these Bay Area buyers coming into California right now, being 70% of buyers here, they have cash, they have deep pockets. And a lot of times sellers are going to choose the one that has cash or a higher down payment because they know they have the money to pay the difference if the home doesn't appraise. So keep that in mind. And I think that's it, Lisa. It's 8 o'clock. We got some questions in. I want to thank you guys for tuning in, all you Chi fans. If you guys are watching on the replay, don't forget to like and subscribe. And remember, I'll be putting in chapters in the description below, so that way you guys can just go through each topic one by one without watching the whole live stream again, because it's like an hour and 26 minutes long. But I want to thank you guys again, Chi fams, for joining us, and we'll be back next Friday. Yeah, Lisa?
Yeah. Next Friday I will not be here.
I need to find somebody then.
Yes. I won't be able to be here next Friday, but the Friday after that, yes.
Okay, so Lisa might not be here next Friday, but I will be here. And if we do have a special guest, you guys are just gonna have to find out who it is. Okay? But if you
Surprise
guys
guest.
have more, yeah, if you guys have more questions or concerns for us to cover next week, I'll put another poll for you guys, or you guys could comment down in this video. But um, let me close out with a few comments. Josh says, good to know, makes me feel better about the market not crashing. Yeah, you're welcome, Josh. That Sibling Life says, thank you guys. You're most welcome. Glad to have you on the live chat. Georgina says, don't make us feel too bad. I'm not trying to make you guys feel bad, Georgina. I want you guys to be prepared.
Yeah.
I apologize if I did. I tend to do that a lot. I just like to educate all my clients so that way you guys can make the best decision, because it's better to know it all up front versus last minute, in my book at least. So it's better safe than sorry because it's a big investment. It's not like buying a shoe or clothing. You're buying a big investment here. So it's better to know all the surprises up front. But thank you again for the comments, and I think we're gonna end it here. All
Yay.
right. All right, y'all. You guys enjoy your Friday. Be safe, and we will see you guys next Friday.